A potential crisis is shaping up in the bond market, which can have huge ramifications for the U.S. housing market and the economy overall. In today's video, we're going to look at the latest developments that have bond investors spooked and what the ramifications from it could be in the months and years to come. Let's get into it. When the Federal Reserve started cutting their Fed funds rate back in September 2024, there were a lot of expectations that this would help bring down mortgage rates, but the opposite has happened. And this has to do with what happened in the bond market. Back on September 18th, 2024, the day the Fed announced their first rate cut, the yield on the 10-year Treasury bond, which mortgage rates track closely, was 3.7%. Since then, the Fed has cut rates further, but fast forward to recent times and the yield on the 10-year Treasury is around 4.5%. At the time of that first Fed rate cut, there were two prevailing theories as to why the 10-year Treasury yield was heading higher. One was because economic data was coming in strong, so perhaps the Fed would not cut rates as much as anticipated. But the other theory about what was going on has been the prevailing narrative since then. The bond market is concerned about the federal debt and continued budget deficits. Over the last few weeks, that narrative has been front and center as recent developments suggest there is a crisis in the bond market taking shape. On May 16th, Moody's downgraded the U.S. credit rating to AA1, one notch below AAA status, citing concerns over the federal debt and budget deficits. This wasn't a complete shock to the bond market. After all, S&P downgraded the U.S. credit rating in 2011 and Fitch downgraded it in 2023. But this was a reminder that the U.S. debt situation isn't getting better, it's only getting worse. Markets shrugged off the downgrade for the most part, but others were warning not to underestimate this latest downgrade. Ray Dalio, one of the most successful hedge fund managers in Wall Street's history, said the Moody's downgrade understates the risk of holding bonds, that it doesn't take into account the possibility that the government could just print money to pay off its debts. Dalio is concerned about the rising budget deficits and having to finance those higher deficits as interest rates are rising. And Dalio is right to be concerned. We now pay about $1 trillion a year just on interest. As interest rates rise, more and more of the federal budget goes to just paying interest. They have to borrow more and more to do so. It's a vicious cycle. Pretty much like taking out a new credit card to make the payment on another credit card, but you never really pay down the balance. It just keeps growing. But as the government borrows more and more, the question becomes, who is going to keep lending to them? Will there be enough demand to absorb the supply of treasuries the government will need to put on the market to cover their deficits? We got a warning sign from the bond market on this point as well. On May 21st, there was weaker than expected demand at a treasury auction for 20-year bonds, adding to fears that we are getting closer to a crisis in the bond market. So what would be the solution to this? We just need to cut wasteful government spending to reduce the deficit, right? Isn't that what Doge was supposed to be for? Well, it turns out that many Republicans in Congress aren't as concerned with the deficit as perhaps they should be. The big, beautiful bill President Trump wants passed through Congress is estimated by many that it will add trillions to the federal budget deficit, not make it smaller. There have always been people worried about the trend in government debt, but it does seem like it's getting more attention recently. Are we in the middle of a crisis right now? No. The 10-year Treasury yield has been rising, but it's only around 4.5% right now, definitely not at crisis levels. But if the current trend of government deficits getting larger and larger over time continues, it will become a crisis. It's just that no one knows when it will really turn into one. If the government doesn't fix this problem, the bond market will, and it will come in the form of higher yields on treasury bonds, which raises borrowing costs for everyone, and that includes mortgage rates. This means that if you're waiting for that 3% mortgage rate to come back, I wouldn't hold your breath. The way things are shaping up right now, it would take a severe economic recession in order for rates to come down. But that brings problems of its own. I don't try to make videos based on hype and speculation for this channel, but even though we are not in the middle of a bond market crisis right now, it doesn't mean there isn't potential for it to happen down the road. If you want to stay up to date on what's happening in the bond market and how that will impact mortgage rates and the housing market in the months ahead, make sure you are subscribed to this channel and hit that notification bell down below so you know right away when my next video comes out. On this channel, I focus on forward-looking analysis for real estate and the economy. So if that's your cup of tea, don't forget to hit that like button on your way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.